Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Here we are on July 1st, 2011, the time getting on right now about 3:10 in the afternoon, coming to an end of the trading week, if you will, trading day, and we all want to leave for the 4th of July. And with that, I want to wish you all a happy Independence Day coming up. Remember, we will not do a taping on Monday. Our offices will be closed. Electronic markets will still trade a bit come Sunday night. Monday night, they get much more back to normal, and Tuesday's, of course, a regular trading day, and we'll all be back here for you. The stock markets had one heck of a rally this week. Many of the indices are up 5-6%, nearly a little more than that. It's okay. Probably getting ahead of itself, so be careful right here. You got your end of the month window dressing. A 5-6% gain in a week is an awful lot to hold on to. Do not forget, today's the first day of the month. A lot of money gets reallocated in a lot of different markets the first business day of a new month. So I think there's a certain amount of that going on. U.S. interest rates, well, they're picking up still in momentum of higher rates. And the gold and the silver market have done pretty much as I forecast. In fact, I sent out just moments ago what we'll call a gold report. I didn't write it this week. It was a survey that 34 of us participated in through Kitco. And we put out if we're bullish, bearish, what we think of the market. And we'll often write reasons why. I write a gold report, as many of you know, every 2 weeks. I was quoted this in this particular one. And I just wanted to show you out of the participants how many of us are bearish and bullish. It's interesting reading. Just gives you an idea what we as market analysts think of the market as a group. All right, let's take a look and see what's going on. Here is your gold-silver ratio. Now, you'll hear about this, especially as we enter the fall period, but not yet. And simply put, this is the amount of ounces you need of silver to buy an ounce of gold. Right now, it's running in the neighborhood of 44. It's been staying over the red line, what I call the line in the sand, which is the 18-day moving average of closes, for a long while. In fact, since it got to its historic point where it was just in the neighborhood of 32 ounces, and now it has come right back, and 43 seems to be a new plateau, 42, whatever that number is, that the market's trading within. Obviously, the higher the number goes, the more ounces of silver, so the silver value falls. Keep that in the back of your mind. Here is a chart of gold, and I've got to just ask you a question. As you're ending the month of June, tell me what's so bullish about this. I don't understand why people are bullish gold still. I'm not. The market at this time of year, it's not uncommon to be bearish. It's not uncommon to see the market weaken, and that's what you've done. In addition, when I put on the chart the 18-day average of closes and my proprietary swing line study, which I developed years ago, you can see patterns. Give you the current pattern. You've got lower highs, apexes, certainly lower lows. What's a bear trend? Lower highs, lower lows. How do you filter it? The line in the sand. When you're under that, you look for potential sales. When you're over it, you're looking for potential buys. There's obviously more to this, and we teach that. The next support zone, and I knew I was getting laughed at. I had comments come to me, it's not going back to the 100-day average of closes, and I was writing about this recently. This is the 100-day average of closes. This is the 45, and this is called convergence. Look at 1522, 1520, 70. You're probably going to get what's called a crossover, which means the 18-day average of closes is about to fall under the 45-day. Mathematically, I don't see how it can be stopped. When that happens, to people that follow crossovers of moving averages, they will probably get new sell signals. Even though the market's way down from where it's at, that's what I would expect. I look at the chart, and I always look at what these black lines are doing. The black lines are called Bollinger Bands. There's two of them, a top band and a bottom. They give you, if you will, theoretical resistance and support zones. And as I step back here, I think they do a heck of a job of that. I don't think you'd disagree. So we're down to a theoretical first support zone. We hit it recently, bounced away. I can see it going under it, bouncing back again, but I don't see anything bullish about this chart. And as I'm looking at the chart momentum, The only thing that you can say is the market is oversold. It's in a bear trend and slightly oversold at this point, not even in the first leg of what I call embedding, where it changes its personality from a bearish chart to a super bearish chart. It's not there yet. It can happen, but I don't see it at this point. Before I go to the silver, I want to remind you all that we put out a futures trading kit. And in that kit, I have my webinars and anatomy of a trade. That's where I do videos. And I go through 39 markets at a time. I do it typically 3 to 4 times a week. And it's like sitting at my shoulder and getting it. Access to it is all through the futures trading kit that we have. You also can get oral and written commentary. Now, the oral part, what's neat is I send out a text message and I send out emails of my update. Now, when I say a text message, it tells you that I put out my webinars. It comes in this futures trading kit that you'll see a picture roll by of. And instead of sending you a CD, which we don't do, we send you a link. But to just give you a link on one of these videos doesn't make sense. But it would be just like you were getting this particular CD. You hit a link, you download it, and we give you your codes to work with. I know it's the 4th of July. So what? You call our office at 1-866-973-2077. Leave your name and number. We'll get back to you Tuesday. We'll get you all set up to try this all out if you haven't tried it before. Otherwise, go to our website, www.iraepstein.com. You can work with it from there. So we got through the gold. Now we're into the silver. Now, the silver's got what I call this elongated Bollinger Band. The longer it goes like this, the more wound up it is. I want you to think of a spring coiling its way in here. And instead of the market being like it was back here, where you didn't have all that pressure, you're now building pressure again. And as much as you don't want to hear me say this, it's still very bearish. To negate the bearishness in the market, you got to get over 35.16, the most recent high. Otherwise, it would not surprise me to challenge the lows that we saw recently in the $33 area. It's not that far away any longer, is it? And, you may go back to the $30 area. What I'm looking for is the market to first break down. The further it breaks down now, the more bullish I get at the end of July, beginning of August. I'm not there yet. I'm still very much in the bear camp. The market that I'm friendly is copper. Copper market, in fact, it's got several days now where it's over the Bollinger Band, which tells me it's ahead of itself. The odds favor this market's going to pull down. But I want you to see how a Bollinger Band, when it gets narrow and then you start moving out, and this is what silver can do on the flip-flop, starts the run. I'll be looking for pullbacks and ways for to come in on the long side of this market. If anything, I don't think we're going back under that $4 mark for quite a while. So looks like $4 a pound is going to be it right now. Doesn't mean I won't be wrong on this. I can be very wrong. But there's a lot to take out right through here, and I think pullbacks in this market look like buying opportunities. This is a chart of the Brent versus the WTI crude oil. I just want like showing it because there's now a tendency where this market's trying to narrow in the price gaps. You can see that instead of extending the difference between the two, they've been coming in. The norm used to be 50 cents to $1. Hard to believe, isn't it? And I'm not dealing years ago. This was the norm for the longest period of time. So you have two different world events. You got plenty of U.S. oil, probably not enough of the world oil, and that's what's going on. In the crude, I'm going to look for resistance against 95.50. Now, if you take out 95.84, all you do at that point is you keep this pattern of what? Higher highs and higher lows in place. The market's in a neutral pattern here. So it can do anything and fight a battle at this 95.50, and I'm not quite certain where it's going. And the Brent crude, in order to narrow up the difference, has to get up and close over 113.24. Now remember, that index that they were releasing the oil at was, I think, in the 112 area. So as you're getting high enough up here, now it gets interesting for the world bids, and we're starting to see oil released from that 60 million barrels that they were talked about. So we'll see if the market can go up. Right now, the Brent still looks to me like it has selling pressure. With that, I'm taking off. I want you to all have yourself a great weekend. I'll be back here on Tuesday. Happy Independence Day to all of us in America, and I will see you on Tuesday. Have yourself a great weekend, folks.